you've been doing everything right. You bought a house, you locked in a decent rate, and every single month when that mortgage payment leaves your account, a tiny voice in your head says, just pay it off faster. Maybe you've even been throwing an extra $200, $500, maybe $1,000 at the principal. Maybe your goal is to be mortgage-free by 45. Maybe you fantasize about the day you burn that final statement and finally feel safe. And when someone tells you that paying off your mortgage early might actually be a mistake, it feels wrong. Like telling someone that eating vegetables might be unhealthy. But here's the thing. That instinct to aggressively pay off your mortgage, it might be costing you hundreds of thousands of dollars. My name is Tom, and I spend way too much time thinking about how people build wealth and how they accidentally sabotage it. If you're someone who is trying to make smart financial decisions, but constantly wonders if you're missing something, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, we've been taught since we were kids, debt is bad. Credit cards, bad. Car loans, bad. Student loans, bad. So we lump mortgages into the same bucket. But here's what most people don't realize. Not all debt is created equal. And treating a 3% mortgage like it's a 22% credit card might be one of the most expensive emotional decisions you ever make. Let's do some real math. Imagine you have a $400,000 mortgage at 3.5% interest on a 30-year term. Your monthly payment, principal and interest, is about $1,796. Now let's say you decide to throw an extra $500 per month at it. That extra $500 would shave off roughly 8-9 years and save you about $70,000 in interest over the life of the loan. $70,000 sounds amazing. It feels like a win. But this is where it gets really interesting. What if instead of sending that $500 to the bank, you invested it? Historically, the US stock market has returned about 10% annually before inflation, and around 7% after inflation over long periods. Let's be conservative and say you earn 7% annually. If you invest $500 per month for 30 years at 7%, you end up with about $566,000. Let that sink in. You save $70,000 by prepaying the mortgage. Or you potentially build over $500,000 by investing instead. Now, I know what you're thinking. Yeah, but Tom, that's not guaranteed. You're right, it's not. But here's the psychological trap. We massively overvalue certainty. Paying off a mortgage gives you a guaranteed 3.5% return in this example. It feels safe, it feels responsible, it feels disciplined. But wealth isn't built by optimizing for feelings. It's built by optimizing for math. And the math says that when your mortgage rate is significantly lower than what you can reasonably expect to earn investing, aggressively paying it off is usually suboptimal. But the story doesn't stop there, because this isn't just about interest rates, it's about leverage. And leverage is a word that makes people uncomfortable. But here's the thing, your mortgage is probably the cheapest money you will ever borrow in your life. If inflation averages 2-3% per year and your mortgage is 3%, the real cost of your loan after inflation might be close to zero. In high inflation environments, you're literally paying back the bank with cheaper dollars. Meanwhile, your home value and your investments may be rising. This is where most people don't realize what's happening. By aggressively paying down a low-rate mortgage, you're essentially choosing to invest more money into your house. And your house, for most people, grows at maybe 3-4% per year long term. The stock market historically grows faster than that. So you're reallocating capital from higher return assets to lower return ones and calling it being responsible. Now, I'm not saying paying off your mortgage is always wrong. If your interest rate is 7%, 8%, 9%, different conversation. If you're terrible at investing and you know you'll spend the money instead, also different conversation. But for someone disciplined enough to invest consistently, this is where it gets really interesting. Let's zoom out. Let's say you're 35 years old. You have 25 years until 60. You have a 3% mortgage with $300,000 remaining. You're deciding whether to, option A, pay it off aggressively and be debt-free by 45. Option B, pay minimum payments and invest the difference for 25 years. If you invest $1,000 per month for 25 years at 7%, that becomes about $811,000. Think about that. And here's what most people don't realize. A paid-off house doesn't buy groceries. It doesn't pay your utility bill. It doesn't give you liquidity. It just lowers your monthly expenses. which is great. But investments give you options. They give you cash flow. They give you flexibility. You can't sell your kitchen cabinets to pay for an emergency. Well, you can, but it's not ideal. This is where the psychology kicks in hard, because paying off your mortgage scratches 3 deep emotional itches. The desire for certainty, the desire to eliminate risk, the desire to feel done. We love the idea of being done. Debt-free sounds like a finish line. Investing doesn't feel like a finish line. It feels ongoing, uncertain, volatile. And volatility messes with our brains. Behavioral economists talk about loss aversion, the idea that losses feel about twice as painful as gains feel good. So when the market drops 20%, even temporarily, it feels unbearable. But when you send an extra $500 to your mortgage, nothing bad happens. No red numbers, no scary headlines. It's calm, predictable, emotionally soothing. But soothing doesn't equal optimal. Now let me tell you a quick story. A couple I worked with, let's call them Sarah and Mike. They were obsessed with paying off their house. They had a 2.9% mortgage, historically low. They were throwing every spare dollar at it, no investing beyond their 401k match. After 5 years, they had knocked off about $80,000 of principal. They felt amazing. But during that same 5-year period, the market had averaged over 10% annually. If they had invested that extra money instead, they would have had roughly $120,000, $140,000 in investments. Instead, they had equity, illiquid equity. And here's the kicker. When Mike lost his job during a company restructuring, they couldn't access that equity without refinancing or taking out a HELOC, which in that rate environment would have been 7-8%. So they had to dip into retirement accounts instead. This is where it gets really interesting. Liquidity is underrated, flexibility is underrated, and opportunity cost, almost no one thinks about it emotionally. Opportunity cost is invisible. You don't see the portfolio you could have had. You only see the mortgage balance shrinking, and shrinking balances feel good. Now, you might be thinking, but Tom, what about peace of mind? This is the strongest argument for paying off your mortgage early. And it's valid. There is real psychological value in owning your home free and clear. If losing your job tomorrow would send you into panic because of that payment, paying it down might genuinely improve your quality of life. But here's the question you have to ask. Is it the mortgage that's the problem? Or is it your emergency fund? Because if you had 12 months of expenses in cash and a large investment portfolio, that mortgage payment wouldn't feel nearly as scary. Often, what people actually need is liquidity, not elimination. Here's what most people don't realize. The wealthy often keep mortgages on purpose, not because they can't pay them off, but because they understand leverage and opportunity cost. They'd rather keep a 3% loan and invest their capital into assets that can earn 8%, 10%, 12%. They let their money work harder than their debt costs. That spread, that difference, is where wealth compounds. This is where it gets really interesting. Let's talk about inflation again. If inflation averages 3% and your mortgage is 3%, the real cost of borrowing is effectively zero. But if your investments grow at 7% after inflation, your real gain is 4%. Over decades, that gap becomes enormous. Compounding is slow at first, then it's explosive. The first $100,000 takes forever. The next $100,000 happens faster, then faster, then faster. And when you divert money away from investing during your highest earning years to kill a low-rate mortgage, you're interrupting that compounding curve. Now let's address the emotional elephant in the room. Debt feels like a weight, even good debt. And culturally, we glorify being debt-free. We celebrate it, we post about it, we throw parties for it. No one throws a party for I kept my low-interest mortgage and invested the difference. It's not sexy, but it's powerful. Here's what most people don't realize. Your mortgage is a fixed payment in nominal dollars. Your income ideally rises over time. Inflation pushes wages up long-term, so that $1,800 payment that feels big today, in 15 years, it may feel surprisingly manageable, but the investments you build in those 15 years, those can be life-changing. Let's run another example. You have a $500,000 mortgage at 3%. Instead of prepaying, you invest $1,500 per month for 20 years at 7%. That grows to about $780,000. If your mortgage balance after 20 years is, say, $200,000, you could literally write a check and pay it off in one day if you wanted. This is where it gets really interesting. Investing first doesn't eliminate the option to be debt-free. It delays it while building more power. You can always pay off a mortgage later with a big pile of money. You cannot retroactively invest money you already sent to the bank. Opportunity flows one direction. Now let's talk risk honestly. Markets don't go up in straight lines. There will be crashes. And during those moments, having a mortgage and watching your portfolio drop feels uncomfortable. This is where psychology matters more than math. If you panic sell during downturns, the strategy falls apart. If you stay invested historically, markets recover and continue upward over long periods. But staying invested requires emotional discipline. Paying off a mortgage requires none. So you have to be honest with yourself. Are you investing with a long-term mindset? Or are you refreshing your brokerage account every 12 minutes? Now, here's a balanced framework you can actually use. Step 1, look at your interest rate. If it's under 4%, you should seriously question aggressive prepayment. If it's above 6-7%, paying it down starts to look much more attractive. Step 2, build a fully funded emergency fund. At least 6 months of expenses, ideally 12 if you're risk averse. This solves 80% of the peace of mind problem. Step 3, max out tax advantaged accounts. 401k, Roth IRA, HSA. These accounts give you tax benefits on top of market returns. Prepaying your mortgage gives you neither. Step 4, invest consistently in low-cost index funds. Boring, simple, automated. This reduces behavioral mistakes. Step 5, if you still want to send extra to the mortgage, do it strategically. Maybe split the difference. Invest 70%, prepay 30%. This isn't all or nothing, but to make it a conscious trade-off, not an emotional reflex. Let's talk about retirement specifically. When people say, I want my house paid off before I retire, what they really mean is, I don't want a big fixed expense when I stop working. That's reasonable. But here's the twist. If you retire with a $1.5 million portfolio and a $1,800 mortgage payment, that payment is not scary. It's just math. At a 4% withdrawal rate, $1.5 million produces $60,000 per year. That's $5,000 per month. And $1,800 mortgage is manageable. The problem isn't the mortgage. It's retiring without enough assets. And diverting too much money to low-return debt reduction can ironically slow down your path to true financial independence. This is where it gets really interesting. We confuse debt freedom with financial freedom. They are not the same thing. Debt freedom is the absence of obligation. Financial freedom is the presence of assets. One feels good, the other changes your life. Look, I'm slightly frustrated about this because I see smart, hardworking people delay wealth by a decade or more because they followed a blanket rule. Always pay off your house early. Rules are simple. Reality is nuanced, and nuance makes people uncomfortable. So let's simplify it with an analogy. Imagine you have a bucket that leaks 3% per year, and you have another bucket that fills at 7% per year. If you have extra water, where should it go? Plugging the 3% leak feels responsible. But pouring into the 7% bucket grows your water faster. Over decades, that difference compounds dramatically. Now, does that mean ignore the leak forever? No, but it means you should understand the trade-off clearly. Here's your immediate action plan. Tonight, run the numbers. Look at your mortgage rate. Use a compound interest calculator. Plug in what you're prepaying, then plug that same amount into an investment calculator at 6-7%. See the difference over 20-30 years. Make the invisible visible. Second, ask yourself honestly, am I doing this for math reasons or emotional reasons? Neither is wrong, but they're different. Third, build flexibility. Liquidity plus investments equals options, and options equal freedom. Finally, remember this. You can always pay off a mortgage later. You cannot go back in time and let compounding work for you. This is where it all comes together. Paying off your mortgage early might not ruin you. You'll still build equity. You'll still have a home. But it might quietly cost you 7 figures over a lifetime if the rate is low and the time horizon is long. And most people will never realize it, because opportunity cost doesn't send a monthly statement. It just shows up decades later as I could have had more. Look, if your ultimate goal is true financial independence, where work becomes optional, then your focus should be on building assets that grow faster than your liabilities. Use debt strategically. Don't fear it blindly. And don't let emotional comfort override mathematical reality without consciously choosing it. If this made you rethink something, good. That's the point. Challenge assumptions, run the numbers, make intentional decisions. Because building wealth isn't about following slogans. It's about understanding trade-offs. And once you understand them, you're in control. If this helped you see your mortgage in a different light, hit the subscribe button, give this video a thumbs up, and share it with someone who's aggressively paying off a 3% loan while ignoring their investment account. Your future self will thank you. I'll see you in the next one.